Okay, thank you all for coming. Thank you very much for the invitation to come and present my paper here today. I think it's a speaker from Puig. So today I'll be presenting my paper, which studies monetary policy transmission to consumption, and I'll show you an analysis of inequalities by gender and race. Okay, so monetary policy through unexpected changes in interest rates can often shape spending behaviors. Because in this paper, I'm mainly interested in studying whether different demographic groups in the US change their spending patterns at different rates in response to these unexpected changes in monetary policy. And secondly, whether any differences that I measure in group responses are fully explained by educational inequality or by income inequality, which are often the main mechanisms used to explain differences in transmission of these shocks. So I do an analysis of consumption responses to contractionary monetary policy shocks, and the main sources of demographic heterogeneity that I will focus on are by gender and race. So a quick summary of my main findings. So I'm estimating the effects of contractionary monetary policy shocks. I find that while consumption falls for all households, it falls more for Black-headed households compared to white-headed households. I do estimate several racial and gender differences in consumption responses of households, and I find that these gaps remain even when accounting for household differences in education or income or debt levels. I next investigate spousal insurance mechanisms and how households can insure themselves against these macro monetary policy shocks. And I find that spousal insurance is very important in the transmission of monetary policy and how much it explains these racial and gender differences in responses. Specifically, I find that spousal insurance mechanisms dampen monetary policy's transmission in these racial and gender inequalities that I measure. So I find more of a difference between, for example, single-headed households, whereas married-headed households, I don't find these differences by gender and race. I then narrow into different categories of consumption, and I estimate that households substitute towards essential expenditures after these contractionary shocks and away from non-essential expenditures. And lastly, I do several tests of asymmetry of the transmission of monetary policy, and I find that it's really the contractionary shocks that are driving consumption responses rather than expansionary shocks. So the literature typically focuses on what happens after expansionary monetary policy. So I make the point that it's really contractionary policy that's creating these inequalities that we see. Right, so this paper is related to several strands in the literature. There's a large literature studying how monetary policy affects inequality, and it's focused on transmission channels of income, debt, and wealth so far. There are several papers that look at gender and racial gaps in response to monetary policy shocks. These have principally focused on labor market outcomes. So different shocks to unemployment or to different employment within occupations. If we see concentration of different groups within different occupations, that sort of study. There's a few papers that look at different gender gaps in wealth after monetary policy shocks or racial gaps in consumption. But there's no study that holistically looks at all of these components together. We do know, though, that consumption does vary significantly by gender and race. So that begs the question, we need some study to really put all of these stories together, and that's what I propose and contribute within this paper. I contribute the estimates of consumption by gender and race. I will show you this trade-off in spending between types of goods. And then I trace the consumption reactions through different employment and income transmission channels. So in a way, I'll give you more of a holistic sense of what's happening with these households. Right, so the data I use is from 1988 to 2019, and it's at a quarterly frequency. For consumption and income, I'm using the Consumer Expenditure Survey, and I disaggregate households by the gender and race of the head of household. So one advantage of using this survey is that households are not automatically assigned a head of household. With the Consumer Expenditure Survey, it's up to the household to designate the reference person who gives all the information about the household. So it can be, it's always one of the two spouses if it's a dual-headed household, but it doesn't mean that it's assigned to one particular person. So in that way, I can break down any gender differences between. For the labor market, I use the current population survey. So from this, I get the data on unemployment, labor force participation by gender and race for individuals. And lastly, I use the monetary policy shocks, which are this high frequency series by Bauer and Swanson. And this is a proposed shock series that is proposed to be exogenous. So they measure many changes in interest rates around monetary policy announcement periods. And they make sure that they are void of any central bank information effect. So these shouldn't be capturing any anticipation of monetary policy changes, but they are these, they should be these exogenous changes in interest rates. Here's some descriptive statistics of my sample. So here we see the median quarterly outcomes for each of the 4 groups of households or individuals that I'm focusing on for this paper. In the first 2 rows, you see household consumption. The first row is durables and then non-durables. We see households spend a larger fraction of their income on average on non-durable goods, but that it's white households that are spending more than Black households on average. We also see that male-headed households spend more than women-headed households on average. So there are some differences in patterns of spending. And typically it's households headed by Black women who are spending the lowest amount on these spending categories on average in each quarter. I then also look at different measures of household income. So you see total income also similarly is higher for white-headed households, especially white men-headed households. Labor income is higher, as well as business, financial income, and savings. And in line with what we would expect, this is just CPS data, so it's common data, right? The unemployment rate is higher for Black individuals relative to white individuals, especially Black men. And the labor force participation rate is higher for men than women. So already from the averages, we know that the averages are different between these groups, but now how will they react to monetary policy shocks? So how do I estimate it? I use a local projections methodology with an instrumental variable to identify this effect of this unexpected change in the interest rate. So the X, the outcome, would be any average outcome for the group. So average consumption of a white male-headed household, for example, or it could be the average durables consumption for a white women-headed household. I then I have various macroeconomic controls like industrial production, inflation, the excess bond premium, which are common to the literature, and I include several lags of those controls in the model. My main coefficient of interest is that highlighted in blue beta, where it's multiplied by the 2-year treasury yield, and that treasury yield is then instrumented with the monetary policy shock series. And so then I estimate this model over several horizons of quarters. So I estimate it from the first period after the shock all the way to 20 horizons, or about 4 years, because that's 20 quarters after the average shock. So I'll show you the total response, impulse response from that. So here are just responses of aggregate variables to this monetary policy shock series. So I just want to show you what generally is occurring in the economy. When we have a 25 basis point contractionary monetary policy shock, our industrial production falls, unemployment rate rises, income falls, and consumption falls as we would expect. And I estimate some difference in consumption between non-durable goods and durable goods. Okay, so there's some substitution between the categories. And these measures are the value of the estimates are pretty consistent with the literature that uses. So this is an unexpected increase in interest rates. Right? Now, what about those four groups that I introduced earlier? Okay, so I'm focusing on white men-headed households, white women-headed households, and then black men and black women-headed households, right? You see the legend on the bottom. On the left panel, I'm showing you from the period after the shock up to 20 quarters after the shock over the horizon. We see total consumption is falling for all groups at different rates slightly for these different households. And in the right side, I'm showing you the response of consumption of only durable goods, where we see that consumption of durables for Black women-headed households is falling significantly more than for the other three groups in the sample. Those are the confidence intervals around those gaps, and I also have tested those gaps that they are significantly different from each other as well. Okay, so following this contractionary monetary policy shock, we see that households headed by Black women are decreasing their spending on durable goods more than other households. I then look at non-durable goods and services. Okay, so this is a more perhaps unexpected picture where we see some households are actually increasing their spending on non-durables. And to explain this, I dig into the categories, subcategories of goods within non-durable goods and services. So I find that households increase their spending on certain non-durable goods and services. These include clothing and footwear, food, utilities, or care spending. Okay, and these are for care spending. It's all households except for households headed by Black women are increasing their spending on care services. The decreased response of consumption is important for spending on household furnishings, technology, entertainment, and transportation. So I take this to show that households are really substituting their spending away from these categories here and towards the more perhaps essential categories there. Okay? When in addition to this spending change, they're also decreasing their spending on those durable goods I showed you on the last slide, right? So if we take all of those estimates together, I think it's really telling the story that expenditures are being substituted away from those non-essential categories towards the essential categories. So next, I want to look into what is explaining these gaps, right? What is the mechanism that could potentially explain those racial and gender differences in consumption behavior? So I take a look at these 5 different mechanisms, which are mechanisms that have been commonly used in the literature to explain monetary policy transmission. Okay, I look at each of these separately. I'll show you a few of them. So for example, if I just look at the response of durable goods spending, and I separate households by whether the head of household doesn't have a college degree or has a college degree, I still find certain gaps within these households. So we see within households that have a college degree, Black women-headed households are still decreasing their durable goods expenditure more than other households in response to these contractionary monetary policy shocks. Okay, so it's not a low education versus a high skill education story. There's something else that's not fully explaining these gaps. What about by household mortgage debt, right? Mortgage debt, or being a mortgager versus a renter or homeowner is another mechanism that has commonly been used to explain why households even respond to changes in interest rates. However, when I look at households that are mortgagers, I still find that households that are headed by Black women are decreasing their spending more than others following this shock. Very quickly, I also look at different percentiles of income, so households within different percentiles of income, and I still find that there are some racial and gender differences in spending responses to these contractionary monetary policy shocks. So if income was explaining all of the difference by gender and race between groups, we would expect that all these lines would react in the same way. They would all be more or less overlapping, but they're not, right? So something else is still explained. I also look at age, I look at differences by geographic location of the household, and those things also do not fully take away all of those, the racial and gender differences. So next I look at the role of spousal insurance. I separate households by whether they are single or they're married households. I do find racial and gender differences in spending persist when just comparing single-headed households, but I don't find differences in gender and race between households among married-headed households. So I take this to, single versus married is an important distinction to make because single-headed households can give us more of an indication of that behavior of the head of household, whereas married-headed households have perhaps these spousal insurance mechanisms or some intra-household bargaining or different behavioral responses that they might have. I also find that single-headed households have higher rates of falling durable spending in response to these shocks, and their salary incomes fall in married-headed households in response to these shocks. In contrast, married-headed households see their business and financial income rise after these types of shocks. They have their savings rise, and I also can estimate spousal labor market participation, and I find that married spouses that were out of the labor force enter the labor force after these shocks. So this tells the story of spousal insurance, perhaps through this added worker effect, where when one spouse becomes unemployed due to these contractionary shocks, an out of the labor force spouse can enter the labor force and help supplement the family. This would also explain why single-headed households see that their salary income falls more than married-headed households at the household level. Right, so I next look at the asymmetry in consumption responses. So whether these consumption responses to monetary policy shocks are state-dependent or shock-dependent. So first I compare periods of high versus low inflation, so around the 2% inflation mark. I compare periods of recessions versus booms in the economy. And lastly, I look at contractionary versus expansionary shocks separate from each other. So I do this using the same local projections IV model, except that I include a dummy variable for that state of the economy period that I'm focusing on. This is pretty standard. Okay. So I find that consumption falls more after contractionary monetary policy shocks in periods of high inflation. It also is decreased more in booms in the economy, right? That makes sense. If there is a booming economy and we have a contractionary shock, consumption would perhaps respond more to that. And lastly, I estimate that it's contractionary shocks. So the fall in consumption from contractionary shocks is much larger than the increase in consumption from expansionary shocks. So there's this clear asymmetry where it's, you don't just have a period of contractionary shocks followed by a period of expansionary shocks and everything is equal in the longer term. We see a more lasting effects and more severe reactions to contractionary versus expansionary shocks. Okay, I do several additional results to the analysis, several robustness tests. First, because I have both responses of consumption and I have responses of income, I can calculate the marginal propensity to consume out of households. It's not a perfect measure of the MPC, but it's some measure of how people's spending is changing when their income is changing. Okay. So I do estimate that these MPCs are higher out of durable than non-durable goods spending. So that's in line with those first figures that I showed you where people change their durable spending more than their non-durable spending when their income is changing after these shocks. And I then confirm that my results are robust to alternative monetary policy shock measures, so the Yarosinski-Karate 2020 or the Wu and Xie shadow rates, which are different measures of monetary policy shocks that are consistent with those. I also compare to just local projections OLS model. I vary the lag lengths, I vary some of the controls I include, and the results are qualitatively similar. Lastly, I control for different recessionary periods. So I split the sample before 2001, after 2001, or before and after 2008. And I find that my results aren't driven by these two periods. It's really a consistent result. Right, so in summary, I showed you that Black women and men are the most exposed to this contractionary monetary policy. I showed you estimates of gender and racial differences in consumption and incomes widen after these shocks, but that spousal insurance mechanisms can dampen some of the transmission. So it can mitigate these differences in responses. One of the important takeaways from this paper is that it's important to understand these individual level effects of monetary policy to determine what is the response in the aggregate. If we just focus on educational difference or income difference, you're missing some of the richer behavioral responses from our estimates, right? So hopefully I've convinced you that there's something else that could explain these racial and differences, different gaps by gender and race in consumption outcomes. That's not just our standard mechanisms that we have. And last, I want to emphasize that monetary policy shocks are not symmetric. So in many macroeconomic models, the focus is on expansionary monetary policy shocks with the assumption that everything is symmetric. So it's important to understand the other side of monetary policy and any unintended consequences of it. So thank you, and I welcome any questions or comments.
So if you're following along online, you can drop questions into the Q&A, and I'll read them out.
Good. I have a question.
First
of all, thanks for your interesting presentation. Then my question is that I noticed that you talked about the household debt, while you didn't talk much about the asset. Do you think that the debt to asset ratio could also have effects? The ratio to a certain extent reflects the household's ability to hide the financial risk and maybe more comprehensive than just focusing on that. I saw that in your descriptive statistics table that there's data about the savings. So I think the construction of this variable may be possible.
Yes, thank you for your question. That's a good point. So I could, I could construct debt to asset ratio. That's the variable you were asking, right? Debt to asset ratio. Yes. Yes. No, I just didn't hear you, so I wanted to make sure. Yes, I could construct it. One of the limitations of the consumer expenditure survey data, it doesn't have very comprehensive data on wealth, so on assets. That's why I focused on showing you response to income percentiles. I then conduct robustness checks on the income using savings or wealth measures or business income. And so I haven't looked at debt to asset ratio, but I think I would expect the results to be pretty similar to what I showed you. Thank you.
Thank you, sir.
I have a question. I'll just ask you a simple one. Did you use the diary or the interview?
I used the interview.
Okay, so that's better at capturing the
Yes.
non-durables, right, than the durables. So I wonder how much, if anything, would change if you use the diary, the diary instead. But
Yeah, so I decided to use the interview because my understanding is that it was capturing the general consumption trends better than the diary, but I will look into that. It's possible, and I know that you contributed a measure of consumption, so I will. So that was to the diary part of it, sir?
Oh.
Is it connected
we
to the
provided a model to provide it for both the diary.
for both? Okay. Thank you.
Right.
Oh, shit.
Yeah.
I didn't see any hands, so I don't know.
Okay, not technical question, but no, but so one thing on your instrument, like if you some idea of why you select that as an instrument, and because I would still expect some heterogeneity there with your consumption of comparables. And then why do we have an increase in the essential consumption? Most of them seems to be more normal goods, and if income is declining, then why would they increase their spending on food and clothing? What is the big mechanism there?
Yes, so so for the instrument, so it is it's a valid and relevant instrument. So in the paper, you can see all of the tests of the validity of the instrument. The idea is that it's identified as an exogenous shock series. So it will influence consumption through its influence on the yield. I mean, that is the explanation. And just to say that that's also how those authors are proposing the use of it. So that the way that the instrument is identified, it's made to be as an instrument for macro aggregate, as an instrument that can explain macro aggregates through the 2-year treasury yield.
So the consumption expenditure was happening. The consumption expenditures you have on the left-hand side.
Yes.
They would have no effect on this instrument.
So the way that the shocks are identified, it's changes to the interest rate around like monetary policy announcements of the interest rate.
Okay.
So it's like these high frequency changes in that very high frequency period. So it should not be affected. Yes. Yes. Oh, and then the second question. So And I would like to dig deeper into categories, if I could, of clothing, food, as you said, right? No, because there are different categories, right? Is it an essential spending or it's a normal type of, we know that there are different types of food spending or clothing spending. So I know I'm generalizing it in a way and saying that they're like luxury spending goods. Perhaps that would be a better way to phrase it. But the idea is that rather than spending on these large purchases like durables or like entertainment spending, it's being spent on maybe going to restaurants, or that is all within the food category, or different clothing, or I don't like more everyday items. But yeah, maybe I need to say it in a different here. Thank you.
I have similar question regarding the unanticipated shock variable. So you are using one as a way to sort of instrument your estimation, but are you also using the same variable to estimate, say, the state dependency? Or
yes, it's the same instrument.
Okay, so basically, even when you are doing these, the state dependency based on the state of the dummy variable, you're still using the same variable to instrument your main estimation. Is that correct, or am I missing something?
Yes, it's the same. It's the same instrumental variable setup. I'm just splitting the periods
Okay.
by state dependence. So I'm looking at, I have like a dummy that it's a high inflation period. So it would just capture those periods of high inflation. That's where that would be the instrument that's used to explain the 2-year treasury yield in that period of high inflation versus the low inflation.
Okay. That does not create any sort of say. I mean, you are using some instrument to sort of meet your sort of primary sort of estimation value, and then you also put in the dummy into the main estimation. So I mean, okay, it's if I understood correctly, so that's like usual practice.
Yes. So this is very common practice. I'm not doing anything new to this specific methodology in the literature. Typically, when these exogenous shock series are used, and then they're used to estimate certain asymmetries or state dependence, that's how it's inputted in the model. Typically, and it's because I'm just taking those values in those different periods, so I can do it for the 2 different states that I'm comparing. You're able to do it with the IV that way.
Thank you.
I didn't see it.
I was just wondering if there's a reason why we focused on like in white households, and then what you would hypothesize that, like if you did the study also including like Asian and Latino households.
Yeah, it's a very important question. I actually started the project wanting to look at more groups. I had some data limitations, and that data on so households that are identified to be Hispanic. It's a later period in my sample. So I start in 1988. The sample started to be collected, I think, in 2003, around that period. So I lost some years. And then data on, so breaking down households by whether they identify as Asian race was an even later time period. I think 2009, around there is when they started. So that was the first reason why I didn't include them in the overall sample. I did do some checks because I was very interested, especially comparing with the Hispanic population. I saw that responses of Hispanic households are more similar to the responses of Black-headed households. So if you had to say which group they are more similar to, that's what.
Thank you. Thank you for the very interesting presentation. I would like to, if you don't mind, go back to the results where you had those, those graphs with the lines going below zero and then going up. I think, well, what I'm trying to say is that I thought that I saw that in some of the results that you presented, although initially the Black women or Black men did poorly, they catch up and they go in the positive territory for perhaps the same amount of time as they spend in the negative territory. So I'm not sure that
Yes.
the balance, you didn't present any balance measure or summary measure. So I was a little confused as to whether they unambiguously show a disadvantage for Black women or Black men in particular. It was hard to read from the graph of what the
Yes.
net effect was. Especially, I think, if you go like one more further. Right, so that one, like you can see that the Black women is the one that recovers the most. Right?
This one?
Black women.
Yes,
Yeah.
yes. So these are these are the cumulative effects over the quarters. So it's what you were saying. Initially, the Black women-headed households are more impacted and then they're recovering, whereas the other households are staying below for a longer period. That's true. I would focus the analysis on the earlier period because those are I'm not sure how much we can focus on like the later third or fourth year hereafter. That's definitely a good point. And within the paper, I tried to talk about the recovery of different households within it.
Because some of the other things also, it was very striking how the coaches. That's why I was confused. So if there is like summary, which of the period that the period of over which you want to report is fine, but over whichever period you choose, it may be good to present like some summary measures of how each group fared over the entire period, the cumulative loss of things.
So these, it is the cumulative though.
The end point. Sorry, I have some information.
So you want okay, I will think about it. Thank you. Yes,
Thanks.
yeah. So I can say on average, usually,
Right, that's what I'm saying.
we would focus on one period. I see what you're saying. Yeah, so in the immediate effect, they're slightly different than the longer term effects, is what you're saying. Actually, I'm not into the video. Yes.
I did so.
Okay. Yes.
Okay.
If I could just say one more thought on that. I will just leave it there. Yeah, maybe I can talk more to you after what I think. Yes.
One definition question about what definition did you use of consumption expenditure? In particular, does it include education? Does it include like the owner equivalent rent?
Yes, so it does include housing expenditures. So then that's either mortgage payments or rental payments, and that's how it's captured.
Because in marginalist theory, mainstream theory, they don't call that consumption, right? Education and health expenditures are considered as investment expense. And mortgage payments are not counted because that's towards your accumulating an asset, right? So it's not typically counted as consumption expenditure. I don't know how sensitive the estimates would be to using the consumption expenditures that's used in the conventional mainstream literature, that those things are.
Yeah.
I don't have much, but I don't know.
Yeah, I did check with removing certain categories from the overall response. And I found it was consistent, but I will double check with that.
Right.
That's a good point, of course.
Yeah, this is Italian economist. His last name begins with P. I forgot the name.
Christopher. I know his work, yeah.
Scientist of time ago. Exactly. He has a very interesting paper which compares different definitions of consumption and this is a problem that we also had to deal with the BLS when we were constructing this measure.
Right. Yes. Let me double check.
Yeah.
Yeah, that's a good point. Let me double check. I know that I didn't include the educational
Right.
spending. Let me double check the mortgage.
The larger item is the mortgage.
Yeah.
And they don't count, like, for example, contributions to insurance. They don't consider
Yeah, I did.
expenditures. So there's a number of things that they take out
Right.
when they define
Right.
consumption.
I did follow the standard literature and like cleaning this consumer expenditure survey. We know that's difficult, and in categorizing goods. So probably I misspoke when I answered your question, but I will double check that. That's a good point. Yeah, because I did follow what what the convention was. But let me double check it. I will just let you know. Yeah, I will check it. Thank you. Do you have another question?
Yeah, a couple of things, again, about assets and debts, right? So I remember you have a breakout here somewhere on mortgagors, owners and renters, right? And if you break that down by race and gender of the household head, right? Here we are. So, there's a lot of evidence that in general credit terms are the credit terms that Black households receive are much worse than white households. So I'm wondering, I'm not remembering a question in the CES on, whether it's a variable or a fixed rate mortgage, right? It's just mortgage payments, right? Yeah. So that makes it trickier, but you can look at something like the SCF for kind of secondary evidence about the degree to which, white households are more likely to have fixed rate mortgages versus variable rates, because those would obviously be more sensitive to a monetary policy shock. At least if we believe that increases in the discount rate change mortgage rates. They do tend to follow each other somewhat. And the other question is the other interest rate that's really affected is credit card debt. So to what extent do people hold debt involving credit card debt? That might be the rates that people receive might be different by race and
group. Yes,
race and gender.
I see that. Yeah, I think that your question on fixed versus variable mortgage rates is one of the questions that often comes up when the effect of the transmission of monetary policy is explained through mortgage type households versus owner type households. So I agree with that point. So I will check to see what the rate is of those two rates by these groups, because I think that could be important. Thanks.
I'm spotting this now. I'm wondering whether in your paper you did elaborate on this sort of bell-shaped response function by Black woman owner of house. So why it does like this, completely different sort of behavior with respect to the other three groups.
No, I don't elaborate on that in the paper. Some of these responses are also sorry?
I'm sorry, please go.
No. I was just going to say some of these responses, this is why I think it's perhaps also important to focus on the first year after first period after the shock. I also think that the sample size is a little bit smaller for these groups of households. So it's not as much of a, directly strict response that I'm estimating, especially for the owner household category.
I'm just going to say the same.
The same, yes. So that's what it is. So that's why then it's not, I can't break down these groups by every single difference at the same time, right? Exactly.
But just going back to the other point about the assets, there is information about the value of the primary residence.
Yes, so I do certain robustness on the income percentiles. So I group households by percentiles of income. I do it also by different types of wealth or savings categories that I aggregate from the consumer expenditure survey.
Generally, they seem to be of poor quality.
Right, yes.
But house values are not. I think the house values are pretty good.
Okay.
The CES
Mhm.
reported values of primary homes are pretty consistent across other surveys if you look at the numbers in the SCAF.
Okay. Okay, thank you. I will check it. Mhm.
It's pretty consistent, but the other stuff is not.
Yeah,
That is about financial assets and liabilities.
right.
That is weak.
Mhm.
But again, the mortgage debt information is of good quality.
Okay. Good to know.
I think that's something that people know more precisely, how much is your mortgage? People generally tend
They
to
know,
like
they remember it, you know.
I don't know, it's like 401k, I mean, some people do remember it.
Thank you.
This is kind of a general question, but are there any main policy implications that you take from this work?
So the policy implication is just, first of all, that there are, the direct effects of our policies, like monetary policy, aren't always seen in the aggregate. So our aggregate, targets of inflation or unemployment aren't capturing these effects. So I think it's important to measure them. I'm not trying to take a stand on whether whatever type of policy is appropriate in the economy. The point of this paper was more to measure those effects of the policies and show that our focus as perhaps the focus of policymakers shouldn't be to assume that policy is symmetric in its positive or negative direction. I think that would be the most direct policy implication of this. And maybe there are other support programs or policy programs that could be instituted knowing that these are the effects that will play out, right?
Has there been a similar exercise for expansion?
So by in the same way. Yeah, so in the first set of results I showed you before, I break down the symmetry of size. If you just take the negative values of those are the expansionary responses. So it's just the opposite sign. That would be your expansionary response. But there are many papers that just estimate the overall monetary policy shock and don't do the asymmetry exercise at the end. So then if I did that and focused on expansionary versus contractionary, the conclusion would be very different from what I'm showing you now. So that's the other point. And many of these exercises are used to inform models that then show the benefits of expansionary policy, and these models treat these shocks as symmetric. So that's why, yeah, it's important. But yeah, people have done this. Mm-hmm. So thank you. Anybody else?